Hello and welcome to the Premium Account Market Update for September 2015. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals, have 17 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today, we look at the macro outlook driving equities. We roll through the ASX top 50. We look at the review of the earnings season results and try to tie that in with some realistic earnings forecasts and where the best place to allocate money for portfolios are at present in light of both technical trends and forward earnings outlook, and that's all wrapped up in a summary of the market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns. We focus on effective ownership around ex-dividend dates, generating above average cash flow, some capital growth. It's all managed under a strict investment mandate, therefore suitable for superannuation funds, and the assets remain in your name. If you'd like to speak with me about an Investor Signals Premium account, please contact me using the details on screen. Moving straight into a graph of the XJO or the ASX Top 50 Index. Global equity markets have obviously been under pressure. We've seen China correct roughly 40% from the highs. The US is off probably something in the order of 10 to 15%, likewise for the Australian market. Really what we're seeing is a risk adjustment where high PE valuations have had to be pared back in light of revised forward earnings growth. We're seeing headline issues such as obviously the volatility out of China, the prospect of the US raising rates, sluggish growth out of Europe. I suspect that the macro trend that's likely to evolve, though, is that the Chinese equity market's relatively close to a floor. We'll start to see slightly better data come through out of Europe, and I think probably over the course of October, November, December, I expect equity markets to improve, and that's the basic thesis of the macro outlook. Australian GDP, so we've had the balance of payments come through for the second quarter 2015. The data revealed a fairly large rise in our current account deficit. I guess the takeaway from it all is that net exports were weaker, but we had firmer public demand. They roughly balanced each other out. I don't see that there's a major shift in the outlook to Australian GDP. I think we track a little over 2%. What that means for Australian equities from a forward earnings outlook, look, in a lot of cases we're dealing with companies that have large offshore earnings, and I'll speak about those individually as we roll through the top 50 stocks. On that note, let's move straight into AGL, and I'll revise some of these earnings results that have come through as I move through these names. So AGL delivered a full year FY15 net profit of $630 million, a dividend of 64 cents. It was essentially in line with expectations. The company's likely to grow earnings somewhere around sort of that 5%, but as I'd spoken about in previous recordings, we could see the dividend increase from around that sort of 65 cents, maybe up to as high as 90 cents or $1, which would ultimately put the stock back on a forward dividend yield of about 6.5%. That's the attractive picture here at the moment, but as I've maintained, I think AGL's got a period of consolidating and moving sideways, but it's definitely on the radar. We've profited from this name from owning it at lower levels, but I think if we are to get a period of consolidation, I'm keen to continue to look at AGL as a sensible buy right for portfolios. Amcor delivered their earnings result. Net profit on a full year basis was 680 million, so on a constant currency basis delivered growth of about 7%, so that was largely in line with expectation. I've spoken at length here on Amcor about the PE issue. It does trade on a high multiple. It is a quality business. It's compressed down to a dividend yield of just over 4%, even in light of the recent pullback in price. If they deliver sort of 7 or 8% earnings growth over the next 12 months, we see that yield push up closer to about 4.7, 4.8%. So I still think it's a buy down here. You want to own this in portfolios, but we've been selling the covered calls and pushing that cash flow from Amcor closer to 10%. So it's a real reminder of why in this environment you need to be running a covered call strategy to enhance portfolio returns, because you're already paying up quality businesses, and if you can get that extra income through the call option, I really think it sort of justifies the risk-reward ratio. AMP delivered an okay result. Earnings were up around 10 to 12% on the same time last year. In the case of ANZ, look, the stock's now back on close to a 6% dividend yield. I think it's near its lows, and I think that sort of fits with my view that I think generally equity markets are getting close to pretty close to the floor or a support level, and we're likely to see a little bit of upside momentum re-emerge over the next couple of months within equity markets. ASX delivered their earnings result as expected, 5% underlying earnings growth. We've had a dividend announced of 95 cents. It's fully franked. The risk here, which we'd really spoken about, where we'd owned it at lower levels, we'd taken profit at $44. I was a little bit worried about this upcoming earnings result, and it's effectively played out as I anticipated. But down here at around $37, I think it's a buying opportunity for cash on the sideline. I'd want to be reallocating to ASX. AZJ came through with their earnings result. Net profit was up about 15% to just over $600 million. The revenue fell away by about 2%. The focus really is on the cost control side. They've lifted their dividend payout ratio from 60 to 70% up to 70 to 100%, so it can't stay there, but that higher dividend is likely to support the stock in the short term. It puts the stock on roughly a 5% dividend yield even at these levels. Any rally back up to around 5.25, I think it makes sense to sell the call options. But interesting, AZJ is probably an okay allocation back into portfolios at these levels. BHP, in line with my view that the market's going through a bottoming process here, I expect BHP to trade higher. We've seen a lot of volatility in oil, predominantly to the upside off this sort of $37 a barrel support level. We're seeing it push back up into the high 40s. I think, albeit we had a retracement last night, I think you're probably looking at a stage where oil price is also putting in a support level and probably some normalization or return to oil prices. I think that underpins BHP. From an earnings perspective, we're seeing earnings slip about 50% on where they were the same time last year, but the company has enough free cash flow and pulling back on capital expenditure to pretty much underwrite the dividend over the next 12 months, so there's not likely to be any reduction in yield. On that basis, we'll put the stock on a 6% dividend yield. I think at these levels the stock's just simply okay value, and I think probably, if anything, risks that it pushes to the upside from this price range. Brambles, so this is a name that we want to continue adding into portfolios. We've been a buyer of it on the pullback here. The earnings result really was just in line with expectation. They delivered just over $1 billion of profit. The dividend for the half was declared at 14 cents, so that takes the full year dividend to around 28 cents, which is in line with expectations. I think the company can grow earnings maybe on a constant currency basis somewhere between 5 to 7%. Fair value for the stock's probably not much more than about $10.50 at maximum, but I've argued that for some time, and as a consequence, where we own Brambles, we've been selling the covered calls predominantly anywhere from say $10.75 up to $11.50, and the added premium that we've collected off those call options combined with the dividend is pushing that yield up to around 10% from Brambles. But for new money sitting on the sideline, you can see there that I've stamped that value. I think Brambles is worth having a look at these levels. And that'll be the case with most of the stocks as I roll through these, given sort of the bias that I have on that macro theme that value is starting to emerge in equities at these levels. CBA, so we've seen CBA get away their $5 billion capital raising. Here at sort of this price, the stock's back on about 5 and a bit percent dividend yield. I think it has the potential to trade back to around $80, but not looking for the banks to really recapture these old highs. We were fairly aggressive with selling covered calls in all the banking stocks just before this sell-off. Those calls won't lapse until mainly out until the end of September, end of October. I think that gives a bit of time for them to recover a little, and hopefully we get another opportunity to resell those calls into the early part of next year. Coca-Cola, the earnings result here actually wasn't too bad. They delivered $184 million profit for the first half of fiscal 2015. Which meant that the declining profits has come to an end. On a forward outlook, the company's guided to around 5% earnings growth. The dividend's 75% franked, and the dividend payment was 20 cents. That puts the stock on roughly a 5% dividend yield. I think it can trade back up to around $9.25. Again, we sold covered calls just before this sell-off occurred. We collected around 30 cents for those, so combine that with the dividend, we've collected around 50 cents of cash flow from Coca-Cola over the sort of last couple of months, and we'll have a look at resetting that again into the early part of New Year to continue to drive cash flow from Coca-Cola. Computershare's earnings result was a little bit disappointing. The market had been looking for about 5% earnings growth. The number actually came through with a miss of about 10 to 15% on the earnings side. I think Computershare's probably found a new floor here at or near $10. Puts the stock back on about a 3% dividend yield. I think for new money coming into the market, it's a tight buy right. Owning it here, selling the covered calls at around $10.25, collecting the dividend and the call premium makes sense there with Computershare, but I think it's going to take a while to win back market support and confidence. CSL delivered earnings in line with expectation, about 8 to 10% growth. The forward statement was a little conservative, only about 5% earnings growth over the next 12 months, but the market hasn't really readjusted the PE valuation in CSL, so the market's still pretty comfortable owning these names that have high US dollar earnings, some moderate growth, international exposure. CSL fits that category. We own it at lower levels. As I'd spoken about earlier or in last month's recording, we sold covered calls at around the $94 level. We got around $2 of income for those. So effectively looking for CSL to finish September at or near that $94. If it finishes a little bit below, we get the full benefit of the extra $2 of income off the call option, and then we'll resell that again into the early part of next year. But CSL, I think base case is that it largely moves sideways. It's at or near fair value where it is at the moment. Not doing there in Caltex at the moment. The earnings result met expectation. Crown Casino, look, this disappointed a little. We expected that. The numbers out of Macau were very weak. The numbers out of Perth were a little bit average. Certainly the highlight was the Crown Casino in Melbourne. But at this level here, the stock's starting to look interesting. It comes onto the radar. Not doing there in Dexus at the moment. Goodman Group, I've marked this one as value. I think anything down here at around $6 with the yield back above 4% looks attractive. Goodman's delivering about 8% earnings growth. GPT's earnings results were pretty solid. The company's delivering about 6 to 7% underlying earnings growth. The stock's yielding about 5%. We're still a buyer of it for new money on the sideline. Happy owning GPT. Any pushback up above $4.50 to $4.60, we take the opportunity to sell the covered call and boost that cash return up to 10%. IAG's earnings result. Look, this probably missed market expectation a little. The 2015 cash profit came in at about $990 million. The natural peril claim costs increase for IAG, and that's really what's detracted from the result. We've seen a fall off in the insurance margins from where they had historically been tracking around sort of 15% plus down to about 10 to 11%. The growth opportunity for IAG is their push into Asia, into China and other emerging markets. As I've spoken about in last month's recording and the month before, Berkshire Hathaway's put in $500 million as an investor, picked up 20% of the reinsurance business for IAG. The market has had a pretty negative response to the earnings miss and that's probably to be expected in this environment. However, I think if we were to look 3 to 6 months out, I'd expect IAG to be trading back above $5.50. That would put the stock on about a 5.5% dividend yield. I think it's good value where it is at the moment, and for new money coming into the market, I like IAG. IPL, I think in 6 months' time, we'll look back and recognise that this is a pretty good buying opportunity for IPL. I think as their Louisiana plant gets closer to completion, the company will have greater free cash flow. There's the probability of increased dividends to or capital returns to shareholders. It's a buy down here. We sell the covered call up at around 360. We're getting around 20 cents for that. So effectively owning the stock here and looking at taking profit on a bounce back up to about $3.80. If on the other hand it doesn't bounce and it just moves sideways, the dividend and the call premium, again, we're getting up to 10% cash flow out of owning IPL on an annualized basis. The housing data in the US continues to remain strong. James Hardie's continuing to trend higher, could deliver something in the order of 20 odd to 25% earnings growth over the next year, so worth keeping an eye on that. Lendlease, really disappointing the price performance here in Lendlease. The full year operating profit after tax come in at around $620 million. The second half dividend per share came in at around 27 cents. I think there's growth next year, which will come through from the apartment settlements, and in general, the residential sales here in Australia are likely to continue to underpin Lendlease. The market's gone a little bit negative on generally the housing cycle here in Australia, and investors have formed a view that it's topping out. I think the market's probably overreacted to that, and I think sort of that theme actually creates a short-term buying opportunity, and we'll look at that as we go through the other names, including sort of Mirvac and Stocklands. But on these numbers, Lendlease trades now on a 5% dividend yield. They should deliver around 10 to 15% earnings growth over the next 12 months, and I maintain that at these levels it's a good buying opportunity. Likewise here with Mirvac, as I said, I think this story of the Australian property market sort of peaking in the context of these residential sales opportunities, I think that's probably overblown, and I'd probably argue that Mirvac looks attractive here. They delivered about 5 to 6% earnings growth. It's pushing back up towards about a 4.5–5% dividend yield. Worth just having a look at, but our preference still remains GPT, Stocklands at these levels, and Lendlease, but certainly GPT and Lendlease are the preferred two picks within the property space. Medibank Private, now this is a position that we've been overweight in client portfolios, and it's turned out to be a sensible place to have money parked given the volatility happening elsewhere in the market. Now, Medibank delivered earnings growth that exceeded expectation. They came in about 10 to 13% ahead of where the market anticipated, so delivered about $290 million of profit. More importantly, on a 12-month outlook into 2016, the company's guided towards further earnings growth of maybe up to another 10%. So we'll see a number something in the order of around $315 million. On that basis, Medibank's yielding around getting close to sort of 3.8%. So I think it's good value and defensive only in light of that earnings growth that's likely to continue to come through. They pay a 5-cent dividend tomorrow, 5.3-cent dividend tomorrow. But I think the stock's likely to bounce sideways. So it's been strong coming into the div. We've been fairly aggressive and sold the covered calls up at $2.50. We've got good premium for that, really, when you consider that we got 6 or 7 cents of premium for that, plus the 5-cent dividend that we're collecting, and allowing for 10 to 15% capital growth there as well. So Medibank's been a great result, and that was one that really I felt quite strongly about, where I've said that the earnings result was going to surprise to the upside, and just a little bit of patience was needed. I really felt the market had the story wrong there with Medibank Private, and that was vindicated off the back of the recent earnings result. So happy there with the position that we've established in Medibank Private. Macquarie Group, look, only just to say that it's had a reasonable sell-off. You know my view that I'd like to see better economic data out of Europe before we really start to take a look at Macquarie for portfolios. But I do suspect that there is the potential for another leg higher in the bull market. It may take another 6 months for that story to develop, and it's only going to occur if we get synchronized GDP growth, and again that's only going to come about as a result of Europe starting to contribute to the global economic picture, and at best we're at the very early stages of that potential playing out, so not quite ready for Macquarie in portfolios. With National Bank, I like this name. I think probably within the financial services space our preference is NAB over Macquarie. At these levels, NAB looks pretty compelling, pushing back up towards a 6% dividend yield. I don't think one can expect earnings results much above 5% in the Australian banks, and therefore on a 6-month horizon, a good outcome would be if the Aussie banks can recover 10% and move sideways. I don't see them doing any better than that. Newcrest, good earnings result really, albeit the earnings went towards paying down debt and not returning capital to shareholders. So we've seen a reduction in Newcrest's debt levels. The company delivered roughly around $500 million of profit, and importantly their production of gold is creeping back up towards 2.5 million ounces a year. Gold prices are remaining pretty steady. So, albeit at a valuation basis, Newcrest is probably worth something in the order of $18 to $20. The market doesn't appear to be recognising that at the moment. We've been fairly aggressive and sold covered calls just to continue to drive a little bit of cash flow in the absence of having the dividend stream available from Newcrest. Origin Energy. Now, I thought I'd just backtrack a little and give you, so Origin Energy controls about a third of the Australian energy retail market. The energy market division comprises about 60% of the group's earnings. Retailing is obviously a highly competitive and low margin business in Australia. Origin's poured a lot of money in developing the Australia Pacific liquefied natural gas project in Queensland, which will start exporting LNG next year. There's still a reasonable amount of money for Origin to spend to finish that project off, so they still have roughly around $1.8 billion capital expenditure. And that's really what's concerning the market. Not only does Origin have a high debt level, they still have further capital to spend before they eventually begin shipping LNG from the project there at Curtis Island in Queensland. From a valuation standpoint, the company's been able to deliver a 25-cent dividend, so on a full year basis they're still paying out 50 cents of dividends. Some have expressed a concern as to maybe it would have been more appropriate for Origin to hold that dividend back and pay down debt. We've seen them sell off their New Zealand assets to help bring that debt level. I think it was around $12 billion, and it's come maybe down just to a smidgen under 10 billion. But again, in light of sort of low oil prices and the need for further capital expenditure next year, the market has been concerned that Origin needs to issue shares and raise capital. The CEO's come out and assured investors that that's not the case, but the short sellers have put a lot of pressure on Origin, Santos, Woodside, and it's probably only a bounce in oil back above $50 that we start to see Origin trade back up to near that $10, which is about where I see fair value. Again, in most cases, we sold covered calls before this sell-off really got underway, so we've collected not only the dividend but a bit of call premium. Those calls don't run out until the end of this month, so we've still got sort of 3 or 4 weeks to play out, where hopefully the stock sort of trades back up towards our target of around $10, and then we get an opportunity to resell those calls again. From a putting aside all the negative headlines on Origin, it's important to understand that the underlying net profit, sort of excluding write-downs and one-offs, really only fell by around 4 or 5%. So the underlying business is still performing quite okay. But it's a real evidence as to the impact those oil prices are having on sentiment and the concerns around these companies having to raise further capital that's weighing on the share prices. I reckon not doing there at present. Oil Search delivered a great earnings result. Net profit came in at $230 million, which was up 50% on the same time last year. Their cost of production per barrel of oil is down at around $10. They've increased their dividend from 2 cents a year up to 6 cents. And the outlook for Oil Search actually looks quite strong. The result was very positive. And again, in an environment where oil prices have been under pressure, I think we'll probably look back in 6 or 12 months' time and recognise this to be a pretty compelling buying opportunity for Oil Search. QBE delivered earnings result that was up roughly around 15%. On a US dollar basis, the earnings came in at $470 odd million, which was a pretty strong first half result for QBE. So on an annualized basis, those numbers are expected to be roughly $1 billion of earnings. Importantly, the insurance margins ticked back up again. But QBE is really a story about where they've gone through fairly major restructuring and consolidation during 2013 and 2014, and I think we're looking at probably a leaner, meaner business over the years ahead, and I'd expect somewhere around this $13 to be a pretty reasonable buying opportunity. I have it putting the stock on just over a 3% dividend yield, so interested in client portfolios that don't have a large exposure to the insurance sector where maybe QBE can be added in. Rio, as with BHP, I think you're looking at, from a price point perspective, where these stocks start to look reasonably compelling. I think the dividends are safe from the reduction in capital expenditure that the companies have highlighted over the next 12 to 18 months. To put some numbers around that, Rio alone has saved over $5 billion in capital expenditure since sort of 2012, 2013. Over the next 12 months, they'll save a further $1 billion. It puts a stock on about a 6% dividend yield. I think these companies have been pretty efficient with managing costs in this sort of low commodity price environment, and obviously increasing production that we all know about. But Rio BHP, a little bit counter-cyclical there. I think they're starting to represent okay value. SCG, we've been pretty aggressive selling covered calls over SCG. Don't see much in the way of earnings growth. It's really a dividend and call option story and driving about 10% cash flow as a result of that. SEEK disappointed the market, in particular with their earnings outlook statement. On a 12-month forward basis, earnings will contract by about 10%. Now, that's largely driven by added capital expenditure, but look, I don't think the market's going to pay a premium to have exposure to SEEK. We keep it on the radar and continue to watch it. It's been a new addition to the ASX 50 index, and we've been a bit cautious in adding this into portfolios, and again, that's been vindicated by the earnings result. We're cautious, or I was cautious that wouldn't meet market expectations. Look, I'm not a buyer of SEEK really unless we see a consolidation at around sort of $10.50. I think is about where SEEK starts to look interesting. Stocklands, I think, is a buy now at $3.90, $4. The stock's good value. The company delivered about 7 to 8% underlying earnings growth. They're obviously a big exposure to affordable housing at sort of city fringe locations. They have strong residential market that's going to continue to, I think, underpin growth over the next 12 to 24 months. If you recall, going back 6 months ago, I explained that the issue with Stocklands is that the company at the time was paying out 100% of their earnings in dividends. So I said, don't expect dividend increases out of Stockland, and that'll ultimately hold back the share price. And that's exactly what we've seen, where we look at the stock over 12 months, it's really just traded sideways. It's only now that the company's starting to build up a little bit of buffer, where it'll continue to pay out 24 cents of dividends per year, but maybe the earnings per share now are starting to tick up to about 26, 27 cents. So that's actually a healthy sign for Stocklands, that they're actually starting to build their cash reserves through not paying out 100% of their earnings in dividends. So I'm comfortable that the company's taking the right approach there. At $3.90, it's a buy. Any rally back up to sort of $4 or $4.20, sell the covered calls. I think Stockland largely moves sideways, but it certainly is at the lower end of that valuation range at the moment. Sonic Healthcare delivered a disappointing earnings result, which we expected. We own the stock at lower levels. We'd taken profit. I really would like to buy back into Sonic, but only if we get a chance to pick the stock back up closer to $19. The company's earnings actually fell by about 5%. It does get a little bit tricky to sort of strip out sort of some of their recent acquisitions in Germany and Switzerland, with the small bolt-on acquisitions that they've done. The stock trades at about 3.8% dividend yield. I have the dividend ticking up to about 75 cents a share in the 12 months ahead, which is about 70% of their earnings that they're paying out in dividends. I think the company's a great opportunity for portfolios to own it and sell a covered call, and a combination of the dividend and the call option drives about 10% cash flow. So we want to continue to look at Sonic for portfolios. Santos, look, the same applies here as my comments to Origin. So dependent on oil prices recovering, the market's concerned about the balance sheet capacity of Santos. I think it's really, the short sellers have really sort of pushed these names down to levels that are probably not sustainable, and there'll be a fairly sharp snapback in the weeks or months ahead in the likes of Santos and Origin. Suncorp, 75% insurance, 25% bank. The company delivered okay earnings result out of the banking sector. Insurance margins were down a little at $12.50. The stock's good value. I think it'll trade back up to $13.50 and trade sideways, but Suncorp's definitely on the radar. Transurban, companies pushing dividends from 40 cents up to 45 cents on a 12-month outlook. I think that underpins this price range here. Full value's up at $10. Don't see it doing any more than that. Telstra, it's a buy down here. I think it'll trade back up to around $6.25 over the next 6 months. The market's got concerned around Telstra having to invest for growth, but I thought the underlying earnings results within Telstra actually were not too bad. The market's, I think, negative on it at the moment, given what's happening at a macro level, especially in Asia, which is an area that Telstra is expanding into, and in particular into emerging markets. But I think here we'll look back and recognise Telstra as a good buying opportunity at these levels. Likewise, in Westpac, across the whole thesis of sort of whether it be BHP, Rio, or the four major Australian banks, I think in line with the fact that we think the market's actually going to recover from these levels, I argue that the banks have 10% upside over the next 6 months. Wesfarmers delivered a good earnings result, about 8% earnings growth, paying out on a full year basis about $2 of dividends. I think the stock's worth maybe $41 to $42, nothing more than that. So we've sold the covered calls up there. Again, the call income with the dividend, we're getting about 10% cash flow from it. Westfield, we own this at lower levels. This is a stock that we hold in most client portfolios. We've sold covered calls around the $9.70 to $10 level. I think that's about full value. Don't see the dividend compressing too much below that. The stock will trade sideways, but ultimately Westfield's a great place to have money invested. I think the stock over, say, a 1 to 2 year period, we could certainly see it trading above $10, but short term, I just don't think the dividend supports a price too much higher than sort of that $10 resistance level that I spoke of. Woolworths. Now, the earnings result here, again, this is interesting where you strip out sort of any one-off items and look at what's been going on in the underlying business. Net profit came in at about $2.4 billion, which was essentially flat on the same time last year. There were one-off items that reduced the profit by about 12%, but at an underlying operational level of the business, earnings remain fairly consistent at 2.4 billion. Now that puts a stock on about a 5.5% dividend yield. The company made no comment around reducing the dividend going forward, so continue to expect around $1.40 of dividend income. Just before this sell-off got underway, we've sold covered calls to drive a little bit of extra income. So instead of sort of that 5% yield, we're getting paid close to 10% to be holding Woolworths while we wait for a recovery. For new money that's sitting on the sideline, I'd strongly urge to look past any negative headlines around Woolworths and start allocating money at these levels. Woodside Petroleum, similar to the view of BHP and Rio, I think Woodside provides okay value at these levels. They announced an interim dividend of 66 cents a share. The company's delivering on productivity improvements. Pluto continues to provide a tailwind to earnings, and I would expect net profit to probably be flat in 2016, but that means delivering a number just over $1 billion of net profit in 2016, and I think that is achievable. That underpins a dividend yield of around 4.5–5% for Woodside that I think is a sustainable payout ratio. So in that environment, I think Woodside can trade back up to around $33–34, and then it pays to sell covered calls over it. And there we are, back to the index. So again, our base case for client portfolios is that we want to be overweight defensive names. So the likes of our Amcor, our Brambles, Westfield, Medibank Private, have another look at AGL, Sonic Healthcare. So there's some names there, and then sort of on the slightly riskier end of the spectrum, some exposure into the resources, oil and gas, and maybe a recovery play in the likes of Computershare, IPL. But in those names where we're looking for recovery play, we're allowing for about 10% capital growth, selling the call options as well, which means that if we do get consolidation in those names, we're getting paid to wait for the recovery. But otherwise, the bulk of the asset allocations into your defensive names, and writing fairly tight covered calls and collecting a combination of the dividend and the call option. I think sort of the volatility at a macro level starts to abate. I think the Chinese equity market's pretty close to finding a support level, and at the margin over the next 3 months we start to get slightly better data out of Europe, which helps to underpin equities. We look back in sort of probably the end of January and recognise that the strength in equities re-emerges from probably November through to December, albeit we're in for a choppy month or two ahead. Thank you for listening in, and if you'd like to speak with me about the Investor Signals portfolio, please contact me using the details on screen.